Vanguard's LifeStrategy funds were launched in the UK in 2011, and they set the standard for cheap, diversified and simple single fund portfolios. However, LifeStrategy funds aren't without their problems. They have a huge UK allocation, far larger than the size of the UK market warrants, and are inflexible because you can't adjust them in any way. Stick around until the end of this video to learn how to produce portfolios inspired by Vanguard LifeStrategy, which produce similar returns and risk, but are significantly cheaper, more flexible, and don't have a UK bias. Why are there 5 LifeStrategy funds? They dial up the risk and return of the fund by varying the percentage of stocks they hold. This ranges from the safest and lowest return LifeStrategy, 20%, which is 20% stocks and 80% bonds, to LifeStrategy 100%, which is a pure global equity fund. The choice of fund also reflects investment goals, with investors intending to use the money in the fund within the next 3 to 5 years opting for LifeStrategy 20, and those investing for longer than a decade going for LifeStrategy 100. Let's take a look at the returns for LifeStrategy funds since they were created in 2011. Notice that LifeStrategy 100 has the highest return, averaging over 9%, whereas LifeStrategy 20 has only returned an average of less than 4% per year. Also notice how wiggly the lines are. This is the volatility of the fund, and you can see that the riskier funds with more equity are also more volatile. If we zoom into the market crash in 2020, you can see that LifeStrategy 100 lost a lot more, almost 30%, in the sell-off and took longer to recover than LifeStrategy 20, which fell less than 10%. Bonds usually provide a safety net during stock market sell-offs, but sacrifice return, which is why LifeStrategy 20 is lower risk than LifeStrategy 100. Let's try to match the return of LifeStrategy funds using only low-cost, exchange-traded funds which are available on Trading 212. In fact, it's possible to do this with very few ETFs. If we use the 5 regional stock market ETFs in the proportions shown here, the red line is a cumulative return of that portfolio. That matches the blue line, which is the cumulative return for LifeStrategy 100, very closely. Note that the time period here reflects the inception dates of the ETFs used to build the portfolio. LifeStrategy is itself a fund of Vanguard funds, so we've simply substituted funds available on Trading 212 and adjusted the weights to match the LifeStrategy 100's returns. But we don't want to reproduce the problems of LifeStrategy, in particular its UK overweight, so let's do that. How large is that overweight? LifeStrategy 100 has 3 UK stock funds, which I've highlighted, and these add up to about a quarter of the fund. However, if we compare with a global stock market index, like this one from MSCI, you'll see that the UK makes up less than 4% of that index, because it has a very small market capitalization. LifeStrategy 100 has 6.5 times the market capitalization weight. How do we adjust the weights to remove the UK overweight? Well, the Europe fund already has a market capitalization weighted allocation to the UK, so we can simply set the weight of our UK fund, the iShares FTSE 100 fund, to 0 and adjust the other weights up in proportion. Alternatively, you could add up the regional country weight in a global index like the MSCI All Country World Index. Now let's repeat this process for all 5 LifeStrategy funds. We're going to have to add some bond funds now, but notice that again we can match the returns of LifeStrategy very closely. And this data again reflects the period where we have prices for all of the ETFs in the portfolio. Once we correct the UK overweight, these are the weights we end up with. These do not aim to reproduce LifeStrategy funds, they're inspired by LifeStrategy, and so are diversified globally. They also vary the stock and bond allocations from 20% to 100%, and so have a continuum of increasing risk and return from 20% stocks to 100% stocks. And these are published as pies that you can copy on Trading 212. An additional benefit of this approach is that the fee is lower than it is for LifeStrategy. The fee for LifeStrategy funds is 0.22%, whereas the fee for these portfolios is considerably less than half of that at 0.08%. What's the catch? Well, you'll occasionally have to rebalance these portfolios yourself, whereas Vanguard LifeStrategy funds do this for you. With the pie feature in Trading 212, rebalancing is very easy, so this doesn't pose much of a problem. We've shown you an example of how to build a diversified global portfolio with different levels of risk. Remember that the exact percentages aren't important. You can tweak those allocations up or down, or substitute other funds, or change the regional allocations based on your own views. But hopefully these example portfolios will provide you with a helpful starting point. These examples should not be construed as investment advice, and your capital is at risk. Please click on like if you enjoyed this video, and do subscribe to the Trading 212 channel if you don't want to miss any new videos.